Welcome to the daily update, where I'll go over the action in the market for Wednesday, July 10th, and then we'll see how things look for Thursday, July 11th. Had another really solid update. A little bit surprising. We have CPI coming out on Thursday and PPI coming out on Friday, but the market just broke out to the upside and kept going. There was probably some short covering going on there because you have a lot of folks that are seeing this internal weakness, specifically in the NASDAQ 100 and the S&P 500, and even across the broad market to a degree. And so they try to front run this and they get in short positions ahead of that. And then when those move against them, they have to buy to get out. And we have a short cover rally. Now, we did have a solid update. We were up over 1%. I was able to close out a number of positions. And if you're interested in that, right now, the website that I have is wide open. I post some ideas and suggestions. And I closed out some positions from last week, had a 30% return, closed out a couple others for a 50% return. I do things a lot different than other folks. And some people are like, wait a minute, this is too boring. That's exactly what I want. I'm trying to create a machine, not this Las Vegas casino style of highs and lows. I just want something that performs well over a period of time, that takes technical analysis and puts a heavy emphasis on that. And then that determines what strategies we implement. Okay. Also know, yes, kind of tying right into that, I do have a program. It's called the SPXInvesting Program. It's still open for right now. I'm probably going to start locking that down later in July, where you can still come on there for free. And then possibly in August, I'm looking at doing a 30-day trial. And then from that point on, it's $97 a month. So something just for you to check out. There are links to the program that talk about it. There's a playlist on YouTube in the description below this video. There's also a link that takes you over to the SPX Investing website. When I get things more locked down, there's a lot more I want to roll out. There are things that I just want to share, but not necessarily in a completely public way. These are things that have taken me decades to develop, and I want people that see an interest in the program to actually have access to that. But at the same time, I'm an educator and I want to help anybody who wants to be helped. That's why I still make the daily videos available publicly, but after the market closes, I still make the weekly videos publicly available pretty much right as I upload them. So I kind of go back and forth between being an educator and then this is a business and I have to run it like that. And I know that I'm just catering to a smaller group of people that can really see the philosophy behind what I'm doing and how I do it, and really think that that's an advantageous way of doing things. Where a lot of people, no, they want the roll of the dice. They want the excitement and the highs and lows. I'm just not like that. So there are a lot of videos that I do post, but everything ends up coming down into the daily video itself. All these other videos are what I consider to be supplemental videos. So let's go back and talk about what happened. And I do have a few extra charts to go through, and I'll explain a little bit more about that as to why when I get there. We did have a higher open. Futures were positive, and we opened above R1 at 55.58. And it looked like, okay, the last couple of days, Monday and Tuesday session, that pretty much set the high for the day, and then we started to drift back down. I was kind of hoping right off the bat, not realizing what would happen later, that we would at least give the 5,600 level a try. Well, we did that later on and just broke way above that. But we hit resistance at R2 at 55.97. So it wasn't quite at that 5,600 level. And because we have CPI coming out and then PPI coming out, and we have this, geopolitical things going on and political unrest going on, you'd think, okay, maybe the market's just going to lay back a little bit. And we did fall back down to R1, but then we kind of got going. Prices rose above R2 and they kept climbing above R3. And we don't see this very often. With the pivot points, they're calculated on an intraday basis on the previous day's action, and they weren't very far apart. So what we don't see is R4 very often. And I actually had to break out the pivot point calculator to come up with that. and we got up to 56.29 with that. So well above the 5,600 level. We were up 1.02%. One of the bigger moves that we've seen in a while. We've seen well under 1% moves lately, at least over the last few weeks, but we were still below average with volume there. We are positive and possibly looking a little too positive now. We were already looking that way, but when we get to extreme positive readings, that's when we enter into an overbought condition, which means that we've gone up too far too fast. Now, we could still go from here. We've been in overbought conditions before, just like when we're going down really far, really fast, and we hit oversold conditions, we wear that off a little bit and then keep going lower. We'll have to see what works out as far as this situation. CPI may really give a clue as to which way the markets are going to go, at least in Thursday's session. And it will be about inflation and interest rates because we're getting the main focus of inflation. Now, there are other inflation reports, but CPI is what everybody pays attention to, and there's so much that's tied to that. And then all the different geopolitical things. One thing that I don't have on the list is there's a NATO meeting right now in Washington, D.C. That's not really impacting the markets at all. But there's this rhetoric and statements and things that come out, and then the political unrest that's going on right now with what's going to happen with the presidential election. That's kind of feeding all into this, and that's becoming what a lot of people are really talking about. None of that really impacts the market, but we still want to pay attention to that just in case it does. So some comments, here we go yet again. The NASDAQ 100, the NASDAQ and S&P, they closed at all-time highs. Mega caps had a good day, and that's what was really driving things higher. And we're still seeing even some more negative divergences that I'll go through. Semiconductors were also very strong in Wednesday's session. And while the Brad market, now, I don't know, is this Brad Pitt? Who knows? Obviously, this is a typo. It should be the broad market also saw some strength on Wednesday. So we are seeing some improvements in some areas. Other areas are still causing us some concern, and I'll back that up with the charts. There were no surprises when Chairperson Powell gave his testimony. Didn't really say anything new. He spoke on Tuesday, then again on Wednesday, and nothing that he said really was that impactful. On a short-term basis, we still have a pretty long list, but now that list is getting even more extended to the upside, meaning overbought. That's what short-term OB, that's short-term overbought. With the Stochc RSI, the Williams percent R, CCI 14 and 20, stochastics, the boom indicator, we're getting even further away from the 20-period moving average, and the RSI 9. This has been the list now for the last number of days, but it's getting even more stretched at this point. Doesn't mean we'll stop. We just want to make note of this. Intermediate term, we are getting a longer list now. We have the Connors RSI, something we don't see very often. The percent B, we closed outside of the upper Bollinger Band. The rate of change going back 50 periods, that's been on and off the list recently. And that just measures, okay, what was Wednesday's close versus the close 50 periods ago. And that's showing some pretty significant move upward. The Arun indicator, the CMB composite, which has been on there a few days, the accumulation distribution, it's showing a little bit of weakness, but it's still looking rather extreme positive. We're even above the +3 channel with the standard deviations chart. So that's extreme positive right now. The Sean trend meter, which actually declined, and the ultimate oscillator, the boom indicator based on 50 periods, and then the RSI 14. We even have the rate of change going back 200 periods. Wednesday's close to 200 periods ago. That's starting to get extreme. Again, not necessarily signaling that everything's going to reverse, just something we want to make note of. And for right now, anyway, Chairperson Powell didn't say anything new to change this scenario, and the market is still anticipating that there might be a rate cut in September. The dollar was down and interest rates were also down. Not very much with the 10-year yield. We closed at 4.28%, where we had been at 4.3%. Still inverted with those bloody yield curves. Sentiment is positive. We actually got out of neutral territory. We had been at 52. We climbed all the way to 58. So this is actually lagging behind a little bit because of a lot of the things that we use for this particular indicator, which is posted at CNN Money, have been showing these negative divergences. And when you only have a few stocks that are really driving things up, these indicators don't necessarily follow along, and that's why it was really lagging behind. And then our trend, we are positive, and we're starting to get pretty extreme positive with that. We've already been concerned about that. Now it's getting even a little bit more extreme. We were up, so the bias is positive. That's usually day to day, where the momentum is the last number of days taken together. We just didn't really have anything major as far as economic reports. We get this every week. The MBA Mortgage Applications Index was down 0.2%. Last time it was up 2.6%. Another one that's not necessarily major, and I don't even have a chart for this. Wholesale inventories were up 0.2%, less than the 0.6% they had expected, and it was up 0.2% last time. So here's the weekly mortgage applications. They were still down, but not as down as much as what we saw last week. Some Isabel Net blog charts, the net bullish sentiment shows that we're getting kind of high right here. Now, this is before the big up move that we saw on Wednesday, at least over 1% compared to what the moves have been lately. But this is looking a little bit extreme right now as it's going up, but it still could continue to go higher. And then here's some different historical events along the way. This is more for historical purposes. And then the second quarter is expected to be the first earnings per share growth quarter. Okay, and I have to move this little bar here. For the other 493, that's the rest of the stocks in the S&P 500. This is just showing the Magnificent Seven and that their earnings are really driving things right now. And we're going to be up for the rest of the stocks in the S&P, you know, the Professor and Marianne part of the S&P, but not up as much. And then the largest seven outperformed over two historical periods. This is just talking about how what we kind of already know here, that it's a smaller group of stocks, the really big stocks that are really outperforming the other stocks in the index. And then analysts are penciling. They're not putting it in pen, and pencils have erasers, but they're penciling in margins, getting back to highs in the second half and setting new records in 2025. This is really bolstering the market, is earnings looking out into the future. And I've started doing a weekly video that's only available on the website where I just go through an update on how earnings are looking. And I also have a recession update to go through how those things are looking. I'm still working on putting together a sectors update just to see any rotation that's been going on here. But this is looking positive going out into the future, which justifies higher prices. And then, and I found this a month or two ago. I use the PE ratio, but apparently there's something called a long-term PE ratio, but I haven't been able to find a definition of that. The takeaway from this is that we're just looking expensive right now, but not quite as expensive as we were when we were running up in 2021. And this is on a valuation basis. And then the 2024 earnings per share, it's tracking a typical non-recessionary year revision trend. And this is just suggesting to this point, now this can always change into something else, but how we've been doing in 2024. And then when you take out COVID, you take out the great financial crisis, you take out Y2K, some of you might remember that. The world was supposed to end when we clicked over to the year 2000, but for some reason we're still here. But I'm a little suspicious of these kinds of charts because if you use this like a buffet and just pick the data out that you really like, you can pretty much reach any conclusion that you want. And then the buybacks are still seeing pretty healthy movement there. This is folks that are buying back their own stock for companies that they work for or own. And that's usually a sign of strength for the stock market. It takes more shares off of the market and they're buying it. So that also pumps up the price. Then passive now accounts for the majority of the U.S. domiciled assets under management. I talk about this in the basic course that when we're really in a solid uptrend, passive, which means you're not trying to pick some magical mutual fund. You're not doing all this research by looking at magazines and going to Morningstar and finding some all-star mutual fund and then jumping into that, which quite often ends up being the wrong time to do such a thing. When we're in a really solid uptrend or downtrend, passive mutual funds or ETFs, they're based on an index because most mutual fund and even ETF managers can't outperform the S&P. So why not just jump into the S&P? And so we're seeing a lot of folks getting more into passive. This would be S&P 500 funds, NASDAQ 100, even Dow funds. These tend to do better when we're in a solid upward move. When we start to run into problems with the market, that's when active type managed funds or ETFs tend to do better, because that fund has, or ETF has, more latitude to do things, to be more defensive, that a regular index mutual fund can't do. All right, then we look at sector. What's seeing a lot of inflows, a lot of money coming into the market. Most of it's going into tech, even though that has dropped off lately. Seeing some money coming back into the consumer discretionary. That's what we want to see. Tesla was starting to bounce up there above its moving averages currently, and a lot of folks see that and go, oh boy, I'm going to jump in. And that helps the discretionary sector. A lot of money going into ETFs. Now, this is a loose, I don't know the definition of ETFs here, but most ETFs tend to be more passive, which means they're based on an index. But there's more ETFs out there than there are mutual funds, and a lot of them can be very specialized. Where we're seeing money coming out of energy, a little teeny bit of money coming into real estate, and we're pretty much flat with healthcare. Where these, especially healthcare, this tends to be more defensive in nature. And then cumulative U.S. equity fund flows from 1 year before to 1 year after the presidential election, where we're seeing a lot of money coming in, where we typically see money going out, and then we hit the election, and then we see money starting to come back in. Now, I did find some interesting charts on Twitter. Maybe I was in the right mood or something, but there are some warning signs, and you'll know that the way I do analysis is we're positive right now. You can't deny that. On a trending basis, our oscillators, some of them are looking too positive. There are some concerns in the market right now, but there's always concerns. It's never going to be black and white. I don't wait for the all green or the all red to make a decision. In fact, when something does turn all green or all red, that's usually when we're pretty much finished and we're looking to go in the other direction. I spent some time here on Twitter, and some of these are pointing out some of the concerns about what we need to be aware of. Now, I don't know how they came up with this, but this is Lance Roberts from Real Investment Advice. He does do a video every day. Yeah, you can actually see him, and he's got more of a production than what I do. But how did they settle on a 37-week rate of change? It's not a Fibonacci number. It's not like half a year. It's not a full year. But somebody was tinkering around and figured out, okay, 37-week rate of change from this week to 37 weeks ago. It says, saw an interesting note from Bespoke Invest, and I do follow them on Twitter. I modified it a bit to show buy and sell signals following big rallies and declines. We just triggered a potential sell signal since we're going up pretty fast right now. So just a warning sign. We could still go up further from here. Maybe CPI is going to play into this, but we're starting to get extreme. And then you can see other times when some kind of a signal was triggered, and then what happened after that with the S&P 500. And sometimes it kept going up. Other times it marked that we were getting kind of close to a top. Other times it actually marked a turn. That's the problem with these indicators. There's nothing out there that's going to tell us absolutely when we've hit a top or when we've hit a bottom. That's why I use a consensus of indicators. And then this is more political than anything, and I usually try to stay away from that, but I'm bringing this up just because the NATO meeting is taking place. There's a gentleman named Jim Rickards. I've read his books. I don't agree with everything he says, but he tends to be very knowledgeable, and he does a number of different interviews throughout the week. Most of his stuff is political, but he is also on Twitter, and I follow him, and it says, as they're meeting in Washington, D.C. right now, NATO says Ukraine is on an irreversible path to membership. In that case, Ukraine is on an irreversible path to being wiped off the map. The fabulous in the collective West still don't get it. Now, the reason I bring this up is we've been battling with the Russia-Ukraine war since 2022, so it's going into its third year. And I'm living right in the middle of that, by the way. I'm in a country called Belarus, which is right in between Russia and Ukraine, and also borders on Poland. So yeah, I pay attention to this. But if this really escalates, this could have an impact on the market. It can impact gold, it can impact oil, it could impact stocks. And it seems like, even though the U.S. has had a stance where Ukraine is not going to come into NATO, it seems like they're pretty much promising that right now. But this is just his opinion on that. You may agree, you may disagree. That's fine. But then Dave Collum over here, who I don't follow on Twitter, says NATO will fight Russia to the last Ukrainian. Yes, heroic determination. So a little bit of dry humor in there as well, even though it's very sad what we see going on. And I see it here, not necessarily where I'm living, but I'm very close to it. And it is just really very sad to see what those folks in Ukraine are actually going through right now. But here, on another note, we might want to use this as some kind of a contrarian indicator. Goldman says investors should start shifting out of cash. Here's where it sees opportunity. When you start seeing headlines like this, it's time to put up the warning flag, meaning that maybe we're about done with this little run up that we've been seeing. And then this is another thing, and I'm going to start watching this. When we had the weaker than expected employment report last Friday, that's a little bit of a concern because this has been the last holdout for the Fed to justify keeping rates higher for longer. And if the employment situation is showing some weakening, I'm plowing through some different charts, and we're starting to see a tick up in the number of unemployed for 27 weeks or over. Okay, now that's over 6 months. Okay, so that's significant. I can see why they picked 27, but it's starting to go up here. And other times when it went up, this often led into some kind of a recession. And this goes all the way back into the 1950s. Just something we want to be aware of. And we're also going to get continuing claims and initial claims in Thursday's session. Tom McClellan had something to post on why he came up. See, I like to sit around and tinker with charts, but what some of these folks come up with is just mind-boggling to me. He says the S&P has risen 7 trading days in a row and 10 out of the last 11. Okay, not really big gains, but we've seen some good profits in the portfolio ideas that I suggest. It says my 9-day up-down oscillator is a simple indicator that counts the percentage of up days over the last 9. Then it smooths it with a 3-day simple moving average. And that's something I do quite a bit. I'll quite often apply a simple moving average, or typically with the short term, I'll use an exponential moving average since it moves a little bit quicker. That's what I do with the ADX. A strong trend can power through an overbought condition like this. And we are overbought right now, but we are not seeing strong breadth numbers to confirm that this is a strong trend. And that's what I've been trying to point out. These are the negative divergences. This is where the S&P is looking strong, but when we look internally, we are seeing some potential weakness there. And then we've never seen anything like this from Sentiment Trader. The number of days in the past 30 sessions when the S&P moves one way and net advance decline moves in the opposite direction. This is another negative divergence that I've been trying to point out. And he also talks about bespoke here. It's been doing one thing while the underlying stocks are doing another. Anyone with a family member with oppositional defiant disorder, I mean, we're just throwing around disorder names like crazy these days, can relate to how maddening this can be. To the greatest degree in history, by far, stocks within the S&P are defiant against whatever the index is doing. That just another way of showing that it's a small number of stocks that have really been driving the indexes higher. Then positions in U.S. equity futures and by asset managers and leverage funds getting to kind of a high reading here. They might be getting a little too bullish with this. And then this is by Stock Traders Almanac, but I'm not including it in the seasonal section. This blue dashed line, this is the NASDAQ, and this is what we've been doing since the beginning of July. And we have some positive seasonality, but my gosh, this is just way far ahead of what normally happens. And then in second place, here's the green dash line, which is the S&P. Purple is the Russell 1000. Those are large caps. And then these solid lines are what the averages are, and then how the small caps are underperforming. Not to be surprised there. Also may mean that we're getting a little ahead of ourselves. Then I think this is the last one. This is looking at the NASDAQ 100 as represented by the QQQs. This is the breadth that are above their 50-day average, where the QQQ is setting all-time highs, going to the moon. We're not seeing that when we look at the breadth inside of the Qs. Now, I follow the S&P breadth very closely. I don't follow the Qs as close as far as their internal measures. All right, let's go back and look through our charts here, where we did open up above R1. We got up to R2 and it looked like, okay, we had a nice little spurt to the upside for the day. And now we're going to fall back and just chop sideways. That's not what happened. We got back above R1 and danced along there for a while. And then we started to break out. We got above R2 and then we danced along R3 for a while. I have to put these on here. They're not calculated by the software. And then lo and behold, we started going up and we actually got above R4 and closed at the high for the session. And there wasn't really anything real that was bringing that about. If anything, there was a sense of complacency that that's going to be a quiet day, kind of like I was thinking. That's why I look at charts. I don't base things on my own logic or what I think is going to happen. I look at the charts to tell me what's actually going on. But nothing really indicated that, at least before the market opened, that we were going to have a solid up day. We are looking good intraday. We have the blue line above the red line. Growth is outperforming value. And we're also not seeing a real huge move up here. It's mainly value had a pretty good day, but growth was still up on an intraday basis. So our end of day, we were up with growth more than value, but both ended up being up as well. Mid caps were up a little bit more. Small caps are up a little bit less. So when we look at our end of day charts, we're declining with small cap growth to value, declining with mid cap growth to value, declining a little bit here with S&P growth to value, but S&P growth to value is still holding up for right now. It had been breaking out recently. Looking at our ETFs, the growth to value ETF ratio is showing more improvement. Not seeing an awful lot of change here. Discretionary was pretty much sideways. We were sideways with staples, so we saw a little bit of an uptick with the ratio from discretionary to staples, but we're not breaking out at this point. Large cap growth going back and setting new all-time highs yet again. This is many days in a row now that this has happened. Also seeing large caps outperforming small caps, setting another new all-time high with this ratio. The Wilshire 5000 set another new all-time high. This is where we're starting to look a little extreme with the ADX. We're above 40, and now the green line is above 40 as well. And doesn't mean we're going to stop, but it doesn't mean we're going to keep going at this point either. It just means we're getting nervous right now, meaning that maybe this upward move is potentially looking to be exhausted. And then I switched this around a little bit. I moved I'm no longer calling the short-term ADX experimental because I've been using it every day since I started showing it a year and a half or 2 years ago. We're also looking pretty extreme here in the short term. And we notice that the ADX and the green line are also above 40, but it can go up from here. And then we are continuing to be below average. This is another classic negative divergence. The S&P is breaking out, setting all-time highs again, and volume continues to be below average. And then we're looking at the NYSE volume, which is not necessarily a surprise. We're coming into the summer months, and we do see a trailing off when we look at NYSE volume. We also see a trailing off with NASDAQ volume during the summer months. Sentiment, not really a change. Tick down just a little bit here with the Ulcer Index, showing there's no fear. We did get the latest reading from Investors Intelligence coming in at 3.5. That's okay right now, and we can kind of roll with that. It's when it gets up above 4, that's when we get nervous. And even with the update that we saw the VIX close higher, both with the line chart, that's the closing value, and with the bar chart, but we're still underneath the moving averages. So when the VIX goes up, we're seeing the volatility of the VIX actually picking up and going above the moving average, both with the bar chart and the line chart. Is this some hedging going on as folks are thinking, okay, this market's just out of control to the upside? I'm going to put on some hedging right now because I'm afraid it's going to come down fast. We're not seeing much of a change, but a little bit of an upward move with the momentum of the VIX, which is strange. An up day and the VIX actually goes up. And then this is the seasonality where we're coming into July here and we kind of bounce around a little bit. What we're looking at are the longer trends, where the first half of the year, we tend to see lower VIX readings, which is pretty much what we've been seeing. And then after we get into July and the summer months, we will often see on a seasonal basis where the VIX will pick up, which typically means stocks are under pressure. The skew index is back up into this red area again, but just barely there. So the market is expecting some kind of a big move. And the equity put call ratio did go down on the daily chart. We're also coming down on the 5-day chart and we're getting extreme. That's when I pull out this other chart. When we get down here to a very low reading, And you can see other times. Now we can still drop further than where we're at right now, but other times when we get to an extreme reading, that often means some kind of a top in the market, but we just aren't quite sure yet when that's going to start to take place. Also, I've been breaking out the 10-day average because the 5 days even been pretty sporadic. We're continuing to decline, and I don't use this like an oscillator like I do the 5 period. I just mainly look at the overall direction. And the volatility risk premium, after giving us a very, very high reading here, higher than what we've seen on this chart, it is coming down, but it's still giving quite a high reading. Just meaning that if you're buying options, they're going to be more expensive. If you're selling options, you'll probably bring in more premium. We declined with this fear gauge, and we ticked up just a little bit here with this other fear gauge, seeing a little bit of a contradiction there. Keeping an eye on this, and it actually looks to be improving when we look at the spread between risky and not as risky bonds. We matched that up with the VIX, where the VIX typically has been going down, even though it went up on Wednesday. And we see this spread tending to come down. That just means the bond market's not seeing a lot of fear, and stocks are not seeing an awful lot of fear. And we're seeing a little bit of an improvement here. We're going up with the S&P. We're starting to go back up here with this spread. Now that's inverted. So this is actually an improvement where the VIX actually came down a little bit since it really went up, because this is on an inverted scale as well. And we're starting to break out a little bit more with our risk on to risk off ratio. It's showing a little more movement than what we've seen so far in 2024. Seeing some improvement here with the advanced decline line based on price, but not breaking out above these previous highs, even though we're setting new highs with the S&P. Still seeing some really good strength when it comes to volume, though. So there's a positive side, that's volume. Negative side, that's price. And we're seeing really healthy advance here in the new highs, but not enough to turn our 5 period up. Our 10 period is still going down to trying to flatten out. But when you take this number by itself and see this starting to go back up, that is more positive. So we're seeing some improvement internally there. And where we were slightly negative with the advanced decline ratio after Tuesday, now we're back to being slightly positive after Wednesday. Accumulation distribution turning back up, and we're getting an extreme reading right now when we measure the distance from the accumulation distribution to the moving average. Kind of getting high now. It could still go higher, but this is the point where we want to keep a close eye on this. The positive side is, though, that the moving average is continuing to go up. This is a bit of a concern. The Chaikin money flow ticked up barely, but we're still seeing the moving average declining. So we're positive, but not seeing some strength here from this smart money indicator, and tick back up just a little bit, but not very much with the Chaikin oscillator. So when we take all three together, the accumulation distribution, Chaikin money flow, and Chaikin oscillator, they're not really giving us an awful lot of confidence right now, but they're not turning negative either. And then looking at the cumulative NYSE advanced decline line, it really shot up. And we're also seeing an improvement here with our regular NYSE advanced decline line. This other NYSE advanced decline line is also showing an improvement, but not necessarily breaking out above previous highs. And we look at the common stock on the NYSE for the advanced decline line, just not really. We're just chopping around here, seeing a little bit more of an improvement when we look at this measure when measuring volume. Seeing the same thing here with the S&P, just kind of a little tick up here with the advanced decline line based on price for the S&P, and just a monster move up when we look at this based on volume. And seeing a little bit of improvement when we look at the S&P compared to the NYSE advanced decline line, but when the red line's below the bar chart here, that means that it's underperforming. In a more solid environment, we want to see the red line above the S&P. And we're seeing some improvement here with our advanced decline line studies. With the NYSE common stock, we came up, but we're below the moving average, just kind of peaking our head above the moving average, even with the S&P, ticking back up with the mid caps and small caps, but still below the moving average. And here's our daily chart. An encouraging thing is we were able to get above this previous pivot point here, which had been acting as overhead resistance. And we have a little bit more room to run to the upside, at least according to the pivot points that are above current prices. On the bottom, we are below average with volume. And here's our one-day rate of change going from Tuesday to Wednesday. We're at this blue line. Now, we could really just go all over the place crazy. But when we get above this blue line, that's when at least we want to make a note of this. Doesn't mean we're going to stop. It just means from one day to the next, we may have gone up pretty far, pretty fast. which we've been just kind of chopping our way higher, and then boom, we just thrust to the upside here. And that's what this indicator is picking up. And then our short-term indicators are all extreme positive with the Stoke RSI, the Williams percent R, the CCI 14, and the CCI 20. Now, right now, anyway, it looks like, that's pretty good momentum. That's why these indicators are so positive. At the same time, you can say, well, we're overbought. Maybe we've gone up too far too fast and are due for some kind of a pullback. Our stochastics also either extreme positive or showing good momentum in the short, intermediate, and long term. Still looking good on a trending basis, above the double and triple exponential moving average based on 20 periods. That's what I use to define the short term, and this is still looking really solid. We're actually seeing some improvement here where we had been seeing weakness with the 20, 50, and 200 period moving average study on the S&P. The Force Index did see a nice little bounce and is not extreme right now. Still looking good with our 20 period moving averages, well above the moving averages, and the lines continue to go up, suggesting the short-term trend is still positive. This is where we're looking really extreme right now. We're blasting out. If I put a +4 channel on here, that's where we would be. And who knows, it might even go into a +5. We don't do this very often, so this is looking pretty extreme now when we measure how far we've gone up, measuring it against different standard deviations. All right, and then with the boom indicator getting kind of far away from the 20 and 50 and showing some improvement when we measure the distance away from the 200. Intermediate term, balance of power just ticked up a little bit, but it's positive. Still looking good on a trending basis with the go, no-go system. Looking good with our highest high values. The TTM squeeze is turning back and looking more positive. It's changed back over to a lighter shade of blue. And then the double and triple exponential moving average based on 50 periods. This is more intermediate term. We're looking really solid right now above the red line and the blue line, and the red line is above the blue line as well, showing that we're going up quickly. And then we are extreme positive with the CMB composite. We've been that way for a few days now. Connor's RSI, don't see an awful lot of readings on this one. We see a lot of initial gyration, but now we're looking extreme positive. And we ticked up just a little bit with the ease of movement, but we are positive. The Erin indicator is still looking rather extreme positive. And we turned back positive with the S&P McClellan oscillator. So this is some of the improvement that we're seeing. But when you look at this longer term, going up with the S&P, not really matching that with the McClellan oscillator, that's negative. But the fact that we're crossing back above zero is positive in and of itself. So we're starting to turn back up with the summation index based on price, and we've been going up based on volume. And this could have been volume actually leading price higher, and it's still showing that. So there may be some more follow through. We're also looking positive again. We were able to climb back above zero with the NYSE McClellan oscillator. So it's starting to tick up based on price and volume when we look at the NYSE summation indexes. This has also been turning positive over the last couple of sessions. This Swenlin trading oscillator above zero based on price and even showing more strength based on volume. Momentum looking positive, possibly a little too positive. The PMO is above this red line, trying to turn up ever so slightly based on price, looking more positive based on volume. So the PMOs that are rising are going up. We're seeing the buy signals turning back up, and the PMOs that are above zero just barely starting to turn up. We're positive with the Elder's Impulse system for the S&P, positive with the parabolic SAR. We're trying to turn back positive with our momentum oscillators. The slope is pretty much right on top of its moving average. The MACD is actually looking a little better above its moving average. So in the short term, trying to switch back positive, looking more positive in the intermediate term. Long term, the TRIX is looking a little more positive. We're still kind of on top of the moving average and declining with the KST. That's a longer term oscillator. Still looking really good when we plot this using moving averages. This is a concern too. We set an all-time high. We're up over 1%, and the bullish percent index declined, but we're still above 50. This is a warning sign to us. We looked a little bit better here with the NYSE bullish percent index. We just barely crossed below 50. Now we're just barely back above 50. And with the NASDAQ 100 setting an all-time high, actually saw a decline. This means a few stocks are really driving everything right now. The money flow is above 50 and was flat. The ultimate oscillator is starting to get extreme positive. And this is another warning sign. This is another primary indicator. The green line's on top, but we're breaking out with the S&P based on price, and the vortex actually declines with the green line. Looking extreme with the 14 and 9 period RSI, on balance volume is still looking positive. We're starting to break above the standard deviation moving average here based on 10 periods. Just means that we're going up pretty fast, not necessarily extreme according to this chart. And we are looking better when we look at the moving average studies inside the S&P. We're crossing back above 50 with the 20. So we're seeing a little bit of an improvement here with our study. We're also crossing back above 50 with the 50. And it's always fun to say. We're going back above 50 with the 100, and we're turning back up with the 200. So that's showing some internal strength, or at least improvement. The Copic curve is just about ready to cross over positive after being negative. The Pring bottom fisher is now not generating a signal. I just wanted to show this chart one more time because I won't, since we've crossed below the red line here. The Sean trend meter actually declined on an up day. That's kind of interesting. And here's the rate of change going back 50 periods. We're coming back above this red line. We could still go higher than this. This is just where we want to be aware of it. And the percent B, meaning that we closed outside of the upper Bollinger Band. That does not happen very often, nor does it happen very often, nor does it happen. Okay, let me try that again. It doesn't happen very often, and when it does, it doesn't last for very long. But it doesn't necessarily mean we're going to reverse. It just may mean that we slow down. We need the Bollinger Bands to possibly catch up. Then this is also looking better too, with our broad market measure of the 5-period moving average of the highs minus the lows. We are getting a little bit further above zero. And then looking at our weekly chart of the S&P, we're breaking well above this R2 level. So that has been holding now for quite a while. And we're looking at our fib extensions. We broke above this 50% level. Now we might bump into this 61.8% level. That's at about 563 or so for the S&P when we use a fib extension. And then our different charts, and my cat says hello. We're looking great on a trending basis with the Heiken Ashi, with the Kegi, with the Renko, and the 3-line break. We did have a new X drawn in here with the point and figure chart. We're still working off of the signal that was generated on May 15th, which is a double top breakout. But anytime there's a new X and it's green, that is positive. Long term, we're seeing some improvement here with our 150 and 200, but longer term also, we're seeing those negative divergences still existing. And then we're going back 200 periods with our rate of change. And I put this whole mishmash of lines on here. And we're getting up into an area where, yeah, we could go well higher than where we're at right now. But when we get above this 20 level, we're actually getting above 30, just showing on a longer term basis that we might be getting a bit overextended. We're positive across all the different time frames and all the different indexes that we look at according to the Keller market model. We're still negative in the long term based on price with bonds. We're negative in the short. Did I say negative? Negative in the long term with bonds based on price. And in the short term, we are seeing a downtrend with commodities and the dollar. No changes on the decision point scorecard. An awful lot of green and blue here. We did have the tech sector cross below 70 with a BPI cross, and I don't see where that ended up changing there. But we have the S&P setting a 4-year high, NASDAQ 4-year high. Bullish percent index, as I pointed out, was above 50. The dollar was up originally, but then it ended up declining later. And then all the sectors ended up being positive, with tech leading the way higher, followed by materials, which have been under weakness lately, healthcare, which is more defensive, utilities, which can be also more defensive, but everything was up. It was one of those buy everything days. We're also looking good here with our NYSE new highs minus the new lows. Reading the raw score just on a daily basis, we have a reading of 90. And we saw a bit of an improvement here with the S&P to the equal weight S&P. So we look at our ratio, it went up and it's breaking out above these previous highs, but it's slowing down a little bit as we saw more broad market participation. The Dow is coming right up to this R1 level. That may provide overhead resistance, and it was up over 1%. The diamonds, though, have switched from being neutral over to positive with the Elder's Impulse system, breaking out above this R1 level, now possibly heading up to R2 with the NASDAQ. and also breaking out above R1, heading up possibly to R2 with the NASDAQ 100. We are positive on a trending basis with the Qs when looking at the Elders Impulse system. The momentum for the NASDAQ 100 is positive, and we're also breaking out above this 50% fib extension here with the QQQs, and we were able to close above that. But we're still seeing a negative divergence here. When we look at the QQQ equal weight, setting another new all-time high, turning up a little bit with the S&P equal weight, but not even coming back to previous highs, let alone setting a new all-time high. So a bit of a negative divergence there. Small caps were up a little over 1%, but just getting up a little more higher into their sideways range. They've gone from being negative to positive with the Elders Impulse system for the small caps. We were able to get back above the 50-day moving average with the Russell 2000 small caps. We're above 50 with the RSI, trying to look a little bit better with the momentum. The mid caps, they were up over 1%, but just really haven't been performing all that well lately. And they've gone from being negative to positive with the mid caps when looking at the Elders Impulse system, setting an all-time high with the total US stock ETF. Apple, this is what's leading things higher right now, setting an all-time high, seeing more of an improvement, just 1/3% or so with Tesla. But the longer we can stay above these lines, the more we might see a golden cross with the trend. NVIDIA, not back to an all-time high, but was up 2.69%. Microsoft setting not quite an intraday high there, but was up almost 1.5%. Meta was also up 0.88% and still looking pretty solid. Amazon was up about 1/4% and still looking really solid there. Google coming back up over 1%, looking pretty solid. Netflix was down over 1%, but just coming off of recent highs. And the FANG index set another new all-time high. The financial sector, as we're getting ready for the banks to report, and that's a pretty big deal. And I think that's going to start before Friday's session, and that could really have an impact on the market. The staples to tech ratio keeps declining, and that's more positive for the tech sector. The dollar continues to be in an uptrend, and it was down slightly, even though it's showing it being up here in after hours. And we're seeing an improvement here when we look at the S&P to the world index on a short-term basis. We're still dropping off when we look at the longer-term correlation. The staples sector was up 0.44% and still above its 50-day moving average, more or less neutral when we look at momentum and actually declining on a relative strength basis compared to the S&P. Utilities dealing with their 50-day moving average, almost neutral with the momentum, showing a little bit of an improvement with the relative strength of the S&P. And real estate just kind of meandering along sideways and not really showing any kind of strength right now. Energy bounced up 0.68%, but it's above its 200-day moving average, but still below its 50-day moving average. And we did decline with the 10-year yield, so we were up with the 10-year, not very much though, based on price. It was mainly a stock show on Wednesday. This is continuing to go up with the ratio. The market is still anticipating that we will have a soft landing, meaning that we will avoid a recession. This ratio, which is an inverse of what we just saw, continues to decline, showing how stocks are outperforming bonds. And then when we look at the S&P 1500, it's outperforming short-term bonds. Another broad market measure is outperforming 3 to 7 year bonds. The QQQs are outperforming 3 to 7 year bonds. The tech sector is outperforming pretty much everything on the planet. This is encouraging, though. We came down to the 250-day moving average here with this ratio, and we're seeing this bouncing back up. That's what happened before we saw a nice little upthrust last October. Now, we're in a pretty extreme positive condition right now with stocks, but the fact that this is improving is encouraging, at least to this point. And then looking at our growth to value ratios, seeing it's holding up fairly well with the Qs to S&P, seeing a little bit of improvement with discretionary to the S&P. Large cap growth is outperforming large cap value. So the large caps are looking good, but we're not looking good with the mid caps or the small caps right now. And this is improving too with our 19-day advanced decline ratio. We went back above 0 based on price, and we're actually showing more strength here based on volume. The S&P to utilities ratio continues to go up. That's positive for the S&P. The staples to S&P 500 ratio continues to go down. That's positive for the S&P. And then we've got another potential Hindenburg Omen, and the Perma Bears are just going to be all excited. It's like, oh, 4th of July came too late. We wanted to celebrate it now. We do have the initial signal from a Hindenburg Omen. If you want to go back and read all this stuff here, I just look at the indicator, which takes everything that you see on this page and crams it into this indicator. It was generated on July 9th. Now we have 20 days going forward from here, and I need to change the date here, which will be sometime in August, to see another spike up. And that would be a confirmed Hindenburg Omen. And you can see other times when we've seen confirmed Hindenburg Omens, that usually didn't make things go very well. Now you have a lot of the perma bears out there who they just see something close to this and they call it confirmed, and that's just not true. Now this is the NYSE Hindenburg Omen compared to the S&P itself, so it's not quite apples to apples here. But we're not seeing another spike, at least right now, with the NASDAQ. We were seeing a whole lot of confirmed signals that meant nothing, but we're not seeing at least an initial signal at this time. So what's our outlook for Thursday? We're positive, and we're seeing these negative divergences and this weakness, but it's showing some improvement depending on what you look at. With some of our moving average studies internally, our new highs, new lows, a little bit with the advanced decline line, those are looking a little bit better. When you look at the bullish percent indexes, no, they're actually looking worse. And we are hitting more of an overbought condition right now. The banks will kick off earnings season. That's probably going to start on Friday. We're going to get the weekly jobless claim, CPI. That's the biggie. And then keeping an eye on all the different geopolitical events that I've kind of already talked about. And then we're going to get CPI on Thursday, PPI and consumer sentiment on Friday. And this is going to be a big day. Let's hope that it's somewhat defining and that it can give the market some clues to what's happening. Seasonality, we are positive with the Dow and S&P. We're neutral to positive with the NASDAQ for July 11th. And we see a little bit of tick off before we see a tick up here during an election year for the S&P, and we'll be on the 8th trading day of the month. Thursday is one of the more positive days of the week. And then looking out a little further, we do see positive seasonality through the rest of summer. And we also see positive seasonality here in July, but it's Stock Traders Almanac that also put out that chart that we looked at earlier that said we've just gone way above what historical norms are on a seasonal basis. And this is also kind of going into that, even though it hasn't been updated in a while. These lines down here, this is what happens on an average basis. This pink or purple line, this is what has actually been happening, and it's even more pronounced now. At some point, you would think we're going to revert back to the mean of what tends to happen on an average basis. And the first half of July is strong. Yeah, it is right now. Second half is up, but not one of the stronger times of the year. And we also see strong seasonality according to the Carson chart, which they have going up until about the 17th of July. Is that Bastille Day or is that the 18th or not? I forget. I didn't participate in the French Revolution. So, all right, we are keeping an eye on these defensive sectors right now. The staple sector, utilities, and healthcare. Those are more defensive. We're wondering, now energy, oil actually fell down a little bit, but we're keeping an eye on the energy sector because sometimes it can be more defensive, sometimes it's more offensive. Our advanced decline lines, they're showing a little bit of an improvement, but not an awful lot of strength right now. Growth to value, it's okay, but not great. Discretionary to staples, not all that great right now. The Copic curve, but another day or so, and that could actually cross over positive. So looking at our smart indicators, as I talked about earlier, they're positive, but not giving us an awful lot of confidence right now. The parabolic SAR is positive. We have both the S&P and the NYSE McClellan oscillators and summation indexes. They're both back to the positive side now. The bullish percent index, it's above 50, but man, it is declining and not showing any strength right now. The Swenlin trading oscillator is back to turning positive and improving. Our 5-period equity put call ratio, it's getting extreme with that really low reading, where the 10-period is continuing to decline, and that tends to be positive on both fronts there. Our oscillators are showing an improvement. We are seeing them trying to switch back positive. Our 20, 50, 100, and 200 period moving average studies are showing improvement, actually coming back above that 50 level again. The money flow, the ultimate oscillator, the vortex, that's positive, but it went down kind of significantly on an up day. The bullish percent index for the NYSE is turning back positive. The financial sector is positive. The momentum for the NASDAQ 100 is positive, but the bullish percent index, it declined while setting a new all-time high. A little bit of a concern there. So our conclusion, we are positive. This internal weakness is continuing, although we are seeing a bit of an improvement here, and we're awaiting this inflation data, meaning CPI. In the short term, we continue to be positive now, but overbought. Intermediate term, we're also overbought. This internal weakness is still there, even though it's showing some improvement, and we're also positive in the long term. We saw the 150 and 200 period moving averages turning back up, but longer term, they are still negatively diverging. Thank you. I really hope you found this helpful. I don't know how long this video was. I think it was longer than usual. I hope that you have a really good day, and I will talk to you in the next video.